If you looked at your terminal 15 minutes ago, right when the closing bell rang, you saw a blinding sea of green.
Oh yeah, massive tape.
Right. S&P 500 closed up 1.1%, settling right around 7,492. The Nasdaq Composite ripped higher, leading the charge up 1.4% to about 26,324. And the Dow added over 300 points, climbing 0.6% to print at 51,625.
I mean, on the surface, the scoreboard looks like the ultimate all-clear signal, right?
Yeah, exactly. Okay, let's unpack this because we have a very specific mission for you on this deep dive.
We really need to dig into the internals today.
We do. We're taking a stack of institutional market reports from today's Thursday, June 18th session, and we are going to deconstruct this seemingly bulletproof rally. We need to figure out if this key reversal from yesterday's hawkish sell-off is the real deal, or, well, if those flashing green lights are hiding a severely fragile market structure underneath.
Because the narrative out there is that this is a massive breakout, especially when you contrast it with yesterday's fear. The tape today tells a story of aggressive, just relentless buying. Wall Street essentially staged a huge campaign to buy the dip.
But the real risk here is the underlying mechanics.
Exactly. The surface metrics scream buy, but the internal mechanics driving that volume tell a much more cautious, highly orchestrated story.
Before we tear into the heavy machinery of the market, I need to set a hard ground rule for you. Today's massive moves were heavily driven by political and geopolitical headlines.
Two very specific ones.
Right. We're talking about a historic U.S. Iran deal and a major social media post from Donald Trump. Listen, we are completely impartial here. We do not take sides, and we're not endorsing any political viewpoints, policies, or figures. Our sole job is to impartially decode the data, tracking exactly how these events mathematically rewired the market according to the source material.
And those events acted as a dual-engine catalyst today. They completely reshaped the global trade landscape in real time. We saw a massive macro event out of the Middle East, coupled with a highly targeted micro event in the domestic tech sector.
Let's start with the macro, because this was a tectonic shift. The U.S. and Iran formally signed a landmark interim peace deal.
A huge surprise to the street.
Yeah, and the immediate tangible consequence of that signature is the agreement to fully reopen the Strait of Hormuz.
Which is the global economy's primary artery for crude oil. Roughly a fifth of the world's total oil consumption passes through that specific bottleneck.
It's massive.
It is. When that artery is threatened by geopolitical tensions, oil prices carry what the industry calls a geopolitical risk premium. It's essentially an invisible tax, an insurance cost baked into the spot price of crude, because the market must constantly hedge against a sudden supply disruption.
But the moment that peace deal crossed the wire, the market instantly vaporized that premium. We saw the immediate mechanical reaction in the commodities pits. Brent crude tumbled 3%, settling down at $77.96 a barrel.
Just fell off a cliff.
Right. And West Texas Intermediate plummeted 2% to touch a 3-month low of $74.23. And obviously, the energy supermajors took the hit. Chevron fell 2.1%, and ExxonMobil dropped 2.7% as a direct consequence.
What's fascinating here is how that commodities crash instantly cross-pollinated with the bond market. You have to trace the causality. When crude oil prices gap down, the market's mathematical expectation for near-term inflation also cools.
Because energy is the base of everything.
Exactly. Energy is the foundational input cost for the entire supply chain. Manufacturing, aviation, maritime shipping, all of it. Cheaper oil inherently means cheaper goods. The bond market algorithms recognize this deflationary pressure and immediately repriced. The 10-year Treasury yield, which is the absolute benchmark for global borrowing costs, pulled back to 4.43%.
And that yield pullback gives the mega-cap tech stocks absolute permission to fly. Lower yields mean the discount rate applied to future corporate cash flows is lower, making those future profits worth more in today's dollars.
Spot on.
So that handles the macro engine. But then we have the microcatalyst. President Donald Trump pushed out a Truth Social post teasing a massive domestic manufacturing partnership between Apple and Intel.
And that specific post triggered an absolute algorithmic frenzy in the semiconductor space.
I'm looking at our source reports, and I have to challenge the narrative here. Neither Apple nor Intel released an 8K filing. Right. There was no corporate press release, no verified statement confirming this partnership. It was purely a social media tease. How does hundreds of billions of dollars in market capitalization materialize out of thin air on something that hasn't even been legally verified? Are we just looking at an algorithmic hallucination?
We are looking at the realities of modern natural language processing bots.
Mm-hmm.
I mean, institutional algorithms do not wait for human verification. They are programmed to scrape social media, parse text, measure the sentiment, and execute block trades in literal microseconds.
Oh, wow. So they just fire blind.
Pretty much.
Oh.
When an LLP bot reads the entities Apple and Intel next to the positive sentiment of domestic manufacturing, it fires a buy order immediately. It is a shoot first, ask questions later market structure. The fear of missing out on a foundational supply chain altering tech partnership forces momentum funds to aggressively chase the tape, assuming they can just verify the details later.
But here's where it gets really interesting. If you look at the Iran deal and the Apple Intel rumor, they're undeniably massive headlines. But do they actually justify the sheer staggering volume of trading we saw print today? Because to my eye, the volume confirmation just looks entirely disproportionate to the news.
Your instinct is dead on there. The trading volume today was heavily distorted by a massive structural anomaly in the calendar.
The holiday tomorrow?
Right. Tomorrow is Friday, June 19th. The physical exchanges and the broader markets are closed for the Juneteenth federal holiday.
But tomorrow wasn't just a regular Friday. It was scheduled to be the quarterly triple witching expiration.
Exactly, or quadruple witching, depending on the specific asset classes involved. This is the massive quarterly event where stock options, stock index futures, and stock index options all mathematically expire on the exact same day. Because the exchanges are locking the doors tomorrow, all of that historic expiration volume was violently pulled forward. It was compressed and forced entirely into today's Thursday session.
I want to make sure the scale of this is completely clear for you listening. We are talking about a record-shattering $8.3 trillion in derivatives exposure being wiped off the board today.
8.3 trillion. Unbelievable.
It's massive. To conceptualize that mechanism, it's like a massive game of musical chairs. Normally, the institutional players know the music stops at 4:00 p.m. on Friday, so they spend all of Thursday slowly, dynamically hedging, moving toward an exit. But today, the venue management walked in at the opening bell and said, we are locking the doors a day early. You have 8 hours to liquidate.
And that forced compression is the key to understanding today's green tape. Market makers and derivatives dealers were mechanically forced to square their books. When you have $8.3 trillion expiring, dealers have to frantically buy and sell the underlying stocks to keep their portfolios delta neutral.
They're just scrambling.
Yeah, they have to roll massive futures contracts over to the July or September expirations, and they have to aggressively rehedge their exposure.
So the euphoric buying we saw wasn't necessarily a wave of fundamental investors deciding the economy is completely healed. It was market plumbing.
100%.
It was just the sheer mechanical force of dealers clearing the pipes before a long weekend.
And the institutional flow data absolutely proves your point. If you track the real money, the massive pension funds, the sovereign wealth endowments, the institutional asset managers, they did not participate in this breakout.
No, they didn't.
In fact, despite the massive gap up in the morning, institutions actively faded the rally into the close.
I see that clearly in the S&P 500 futures data. They ran face first into a heavy technical resistance zone.
Right around that 7,500 mark.
Right, specifically between 7,500 and 7,517. But instead of providing the volume to break through that ceiling, the big money desks used the retail liquidity to distribute stock. They took profits and refused to carry overnight directional risk into a 3-day weekend full of global headline risk.
They wanted no part of that overnight exposure.
Let me push back on that bearish read for a second, though. I'm looking at the VIX, the volatility index. It slid 7.5% today, dropping all the way down to 17.06. Just yesterday, it was spiking over 18. You call this a cautious, fragile market, but couldn't you argue that clearing $8.3 trillion in derivatives actually removes a massive structural overhang of anxiety? Isn't wiping the slate clean inherently bullish if the fear gauge is dropping that hard?
That is the ultimate trap of expiration days. You really can't fall for that. The drop in the VIX today was completely artificial. It's a mathematical illusion tying directly back to that options expiration.
How so?
Well, the VIX is calculated based on the pricing of S&P 500 index options. When dealers are forced to let trillions of dollars of protective put options natively expire without rolling them forward today, the formula that calculates the VIX automatically drops. The underlying institutional fear didn't magically vanish. The insurance contracts just expired. Volatility is resting right now, but it is absolutely not dead.
That completely flips the narrative. The market isn't safer. The institutional safety nets have just been temporarily removed.
Exactly.
And if we look at the broader macroeconomic environment, the reason those institutions are nervous makes perfect sense. We have to rewind to yesterday's Federal Reserve decision.
Yeah. If we connect this to the bigger picture, we have a brand new Fed chair, Kevin Warsh. And his debut yesterday fundamentally altered the cost of capital. Chairman Warsh held the benchmark interest rate steady, keeping it parked in the 3.50% to 3.75% range.
But the real damage was what he did to the forward guidance.
Oh, he completely gutted it.
He essentially ripped it up. Looking at the updated dot plot, which maps out the specific rate projections of individual Fed officials, 9 of the 19 officials are actively projecting further rate hikes in 2026.
The market spent the last 6 months aggressively pricing in a rate cut cycle. Instead, they're facing a hawkish wall where half the committee is threatening to tighten conditions further.
Which perfectly explains a massive anomaly I found in the breadth data today. We've been talking about the S&P and the NASDAQ surging well over 1%. But if you look at the Russell 2000, the index that tracks small-cap companies, it actually closed in the red.
Down on a day like today.
Right. It dropped 0.72% today. You have 56% of S&P 500 stocks trading above their 50-day moving average, but small caps are actively bleeding out.
This great divergence is the defining characteristic of the 2026 market. We are watching two completely isolated economies operating on the exact same ticker tape. Mega-cap tech, the massive cloud providers and hyperscalers, they are structurally insulated from Chairman Warsh's interest rate policy.
Let's run the numbers on that insulation. Our reports show that the major hyperscalers are projecting a combined $723 billion in artificial intelligence capital expenditures just for this calendar year.
$723 billion.
My immediate thought is, how on earth does any corporate treasury finance that level of capex with the risk-free rate sitting near 4%? Are they just absorbing massive debt penalties?
No, they don't have to absorb any debt penalties because of the structure of their balance sheets. These megacaps generate such astronomical free cash flow that they can entirely self-fund that $723 billion build-out totally out of pocket. They do not need to go to the bond market to beg for financing at elevated rates.
But the constituent companies in the Russell 2000 are living in a completely different universe. Small-cap companies operate on razor-thin operating margins, and they rely heavily on variable-rate short-term debt to fund their daily operations. Every time Chairman Warsh hints at higher for longer, the cost of servicing that variable debt compounds.
They're choking on it.
They are actively suffocating under this specific interest rate regime. Today wasn't a broad, healthy market breakout. It was a targeted mega-cap tech hijack.
And we saw that dynamic play out brutally in the high-valuation growth sector today as well. Look at SpaceX.
SpaceX dropped another 6.5% today. It has been a relentless slow bleed since the IPO.
It's ugly.
In a zero interest rate environment, you can float a massive valuation on a cool narrative and future promises. But at 3.75% rates, as our sources noted, the gravity of execution has officially met the hype. If you cannot deliver the quarterly free cash flow to justify the multiple, institutional capital will ruthlessly abandon you for the safety of mega-cap tech.
Yeah, the patience is gone. Now, if we pivot from the macro mechanics to the specific momentum movers, the real standout subplot of the semiconductor rally today was the memory makers. Western Digital surged 7.7% into the close, printing at $766.71, and Micron jumped 8.1%, closing at $1,142.
And this was not just sympathy buying off the unconfirmed Trump Intel post. There was a hard fundamental catalyst here. Apple CEO Tim Cook gave a highly circulated interview to the Wall Street Journal, and he explicitly stated that the skyrocketing costs of DRAM and NAND memory chips are making consumer hardware price increases completely unavoidable.
For a semiconductor analyst, that quote is the absolute holy grail. It confirms that the hardware bottleneck of the entire artificial intelligence supercycle is high bandwidth memory.
You can't run the models without it.
Exactly. You can design the most advanced AI logic processors on the planet, but if you don't have the specialized memory to store and rapidly move those massive data sets, the processor is totally useless. The memory manufacturers possess ultimate pricing power right now.
So what does this all mean for Monday's open? Let's get into the institutional playbook for the listener actively managing a book. Micron is seeing incredibly aggressive target price revisions. Analysts are pushing their targets as high as 1,500, and they are scheduled to report earnings next week on Wednesday, June 24th.
which sets up a classic pre-earnings run for Monday. The Day 2 playbook dictates that you do not change this closing print. Instead, you wait for the initial morning shakeout. If Micron pulls back into the 1110 to 1120 zone, that is your high conviction accumulation level.
But you have to manage the risk.
Always. You must respect the risk management. You place a hard stop loss just below 1090 to protect your downside if the broader market rolls over, and you target a move toward 1200 as momentum funds try to front-run the Wednesday earnings call.
Let's apply that same discipline to Intel. We tracked that wild algorithmic spike. It shot up 12% to an all-time intraday high of $135.48 before reality set in, fading to close at 131.06.
Still a huge day, though.
Yeah, it still finished up 8.22%, pushing Intel's valuation north of $600 billion. But how do you structure a trade around completely unconfirmed news flow?
You let the market geometry do the work for you. For a Day 2 play on Monday, the critical pivot level is that 135 mark. The strategy is to let Intel retest 135 from below. If the volume confirmation is there and it breaks through and successfully holds 135 as a new support floor, the momentum algorithm has fundamentally changed the trend. Your upside target becomes 142.
And if it gets rejected?
If it breaks down below 132, the trade is immediately invalidated. The momentum is dead. You step aside entirely. You absolutely do not want to be holding directional long exposure if Apple's PR department releases a statement on Monday morning denying the manufacturing partnership.
That makes sense. Finally, we need to map out the battleground for the broader S&P 500 index. Where are the institutional trenches drawn when the bell rings next week?
The immediate near-term support floor for the S&P is 7,420. That is the absolute line in the sand. If we open on Monday, retest 7,420 and catch a bid, the bulls retain control of the tape. But if 7,420 breaks on heavy volume, the structure is totally compromised.
The institutional reports describe the space below 7,420 as a trapdoor.
A trapdoor straight down to the gamma wall sitting at 7,301, which perfectly aligns with the 50-day moving average.
I want to clarify the mechanics of a gamma wall for you because it's heavily misunderstood as just a static wall of limit orders. That is fundamentally incorrect.
Oh, entirely. A gamma wall is dynamic. It represents the price level where options market makers have massive concentrated exposure. If the market starts aggressively dropping towards 7,301, those dealers who are short options are mathematically forced by their risk models to dynamically delta hedge.
To save themselves.
Exactly. To keep their books perfectly neutral, they're forced to step into the open market and aggressively buy the underlying stock as it falls. It creates a forced buying trampoline effect that bounces the market.
But the ride from 7,420 down to that 7,301 trampoline could be a violent, unhedged elevator drop. And because we just witnessed that historic $8.3 trillion options reset today, the mathematical probability of Thursday's trend smoothly continuing on Monday is actually quite low.
Yeah, the quantitative models show only about a 40% probability of trend continuation. Normally, a strong trend day carries a 60% or higher chance of follow-through. But because we just stripped all the derivative gears out of the machine, the market is highly susceptible to mean reversion and choppy, directionless trading.
So bringing all these threads together for you, today's blinding sea of green was not a reflection of a fundamentally healed economy. It was driven by the sudden evaporation of a geopolitical oil premium, heavily distorted by an unconfirmed algorithmic tech rumor, and artificially magnified by a forced $8.3 trillion holiday options pull forward.
A perfect storm of mechanics and headlines.
Right. And all of this occurred while the small-cap foundation of the market actively cracked under the immense weight of a hawkish Federal Reserve.
Which leaves us staring at a deeply unsettling reality for next week. This raises an important question. We just watched $8.3 trillion in derivatives completely clear out. The gamma buffer, the constant market maker hedging that acts as a structural shock absorber to suppress wild intraday swings, has been temporarily erased.
It's a massive risk. We are essentially taking the shock absorbers off a high-performance car while it is driving at 120 miles per hour. When the market reopens on Monday, after 3 full days of digesting global headline risk, what happens to a market flirting with all-time highs when it is suddenly stripped of its institutional safety net?
It creates an environment where price discovery becomes incredibly violent. Without those dealers mechanically forced to buy the dips to hedge their books, the trapdoors open much, much faster.
And that loops us right back to our original warning. When the scoreboard is completely green and every headline feels euphoric, that is precisely the moment you need to verify where your emergency exits are located. Into the close this week, the real money faded the strength. When we open on Monday, you need to demand volume confirmation before chasing these caps. Keep your position sizing defensive, protect your capital with disciplined stops, and most importantly, step away from the terminal and enjoy the long weekend. We will be right here parsing the data when the bell rings on Monday. Thanks for taking this deep dive with us.